good evening, traders from across the globe, especially you traders in lovely Las Vegas, and welcome to another edition of Short-Term Trading Live with Oscar. Traders, my name is Oscar Carboni, and I've come off the pits, out on Wall Street, off the floors on TV to teach you traders tips, tricks, and techniques that I've spent my entire life perfecting. And traders, let me tell you something. When you work in this environment, as you're growing up in this business, you learn a lot about insider tips, tricks, and techniques that help you survive in the trading industry. As you know, we are trading a day-to-day shift here. We trade every day looking forward. And what I put in these instructional videos for you each week and each evening, if you're watching YouTube, is I try to teach you and show you what's happening in the markets right now so that going forward it's useful information to you. You will be watching this video on Saturday morning if you are a local Vegas fan, and likely you'll be watching this on YouTube tonight if you're a YouTube fan. Traders, we have a situation going on now that requires that I speak to you about a formation in the markets, and of course it revolves around the dollar index. Before we go any further, remember this: futures trading is extremely risky and can cause substantial financial loss if you do not have risk capital to lose, if you do not place your stops first, if you do not understand the risks behind this game, you should not be trading. But for you traders that are out there, you do know the risks and you want to learn more about analysis, rock and roll, baby. Let's go. Tonight's show and Saturday morning's TV show is about a head and shoulders formation that is building on the dollar index. Traders, if you do not realize this, what's happening right now in the markets, this date as we speak, the dollar index is king. If the dollar moves up, the rest of the markets violently move down. If the dollar moves down, the rest of the markets violently move up. There has been fixed focus on the dollar lately, and of course we have our fundamental problems around the world, and they are fixated on the dollar and what the Fed is doing. That brings me to the lesson that you will get in this show. The dollar index and the stock market generally trade in opposite directions, as you can see. When the dollar is rallying, the likelihood is the stock market is going down, and if the dollar goes down, the likelihood is the stock market goes up. What I would like to show you and discuss with you in this show is that this big head and shoulders forming on the dollar index, a head and shoulders is considered a topping pattern. If in fact this is a topping pattern in the dollar, that should mean that we're at a bottoming pattern in the U.S. stock indices. Now, dollars and bonds tend to trade in the same direction and opposite the stock market. The same formation, that head and shoulders that I see in the dollar index, I also see in the U.S. 30-year Treasury bonds. So, if dollars and bonds rally together and dollars and bonds drop together, dollars and bonds, as I said, go opposite the stock market. If the dollars and the bond chart have this big head and shoulders topping pattern forming, that should absolutely mean that the stock market should be finding bottom down here somewhere. So I am going to take you in a few moments into my chart laboratory, and I'm going to show you some charts. One of them will depict how the stock market and the dollar do go opposite one another, and the other charts are going to show you exactly what's going on with the dollar index, possible head and shoulders topping area, with the bonds, possible head and shoulders topping area, and if that's the case, the possible bottom area coming in the U.S. stocks. Now, as you know, the U.S. stock market has been steadily bottoming since 2009, March of 2009, when we made our lows. Since then, we've had major rallies with some pullbacks, but overall, the stock market has been basically in a bull market. What we're worried about right now at this moment in time is there's been a bit of a pullback in the stock market, and traders are wondering, is this the beginning of another washout like 2008 in the stocks? And the charts that I'm going to show you in a few moments would probably be contrary to that opinion. In other words, If, in fact, and if is a big, big, big variable when trading and doing technical analysis. However, if the big head and shoulders that I'm going to show you in just a moment is true and finally completes itself in the dollar index, that would mean the dollars and the bonds will start to come down, and that will buoy our U.S. stock market, and that's what I'm hoping to see. Traders, remember, these shows are for you, for exactly what's going on right now, for you to figure out what we are involved in the markets at this point in time, so that these shows help you going forward figure out where we're going next. A lot of the analysis I am going to show you, in fact 99% of the analysis I've ever done in my whole career, and I'm 30 years deep, I have done on Metastock, traders. Metastock is probably the best charting program I have ever seen. I've been using it since I'm 18 years old, and I'm no longer 18 as you can see, but I'm still using this program, and I've been a beta tester on the street for all the major guys out there. I'm talking TOS and everybody else. They used to come to me with their programs. Metastock did as well. I've stayed with Metastock my entire career. I would like for you to get a version of Metastock so you can emulate the exact same analysis that I teach you in these videos. Simply go to www.metastock.com/TG7 and get yourselves a free copy.
Making money in the markets is not an easy thing to do.
That's why I chose Metastock, the award-winning analysis and data package.
Metastock uses technical analysis, good solid information.
Not just hunches or guesses. This helps me make better trading decisions.
I find the best trades and I can decide when to buy and when to sell.
With Metastock, I trade more confidently.
And that's helped me be more successful.
Go to metastock.com/TG7 right now to get your free 30-day trial of Metastock software.
I love Metastock.
Okay, Omniacs, let me show you what I was discussing with you. This very same chart you just seen a moment ago depicts very easily, and easy for the eye to see very well, that the dollar index, when it goes up, the stock market goes down, right? Dollar up, stock market down, dollar up, stock market down. Not every single day does it act that way, but almost always, if your dollars are rallying, your stocks are dropping. So, of course, if the dollars were topping out, wouldn't that mean that the stocks were bottoming out? That is what this lesson will be about today, and it involves the head and shoulders formation on the dollar index. The head and shoulders formation simply looks a lot like this. When you're in a chart and it's filling in, it moves up a little higher, it moves back down, and it ends up building what's called a head and shoulders formation. And let's get right into it here, traders. The dollar index, before I show you what it is doing today, I'm going to take you back to the summer of 2010. Traders, this is the dollar index summer 2010, not what we're doing today, but back in the summer of 2010. The dollar index cash builds a left shoulder, a head, a right shoulder, and look what happens, big, big dump. That's what you'd expect when you see a big, long-lasting head and shoulders in a market. So you have left shoulder, head, right shoulder, big dump. Lots of times what you will get is a head test before the dump. In other words, shoulder, head test, it tries to go up towards the middle to the top of the head. If it fails getting up here, you get the miserable break like you see here. So this is summer 2010. Another look at the same chart with the head test area drawn in. Summer 2010, dollar index cash, again, same chart. Left shoulder, head, right shoulder, runs up for the head test, fails near the head test, and breaks severely. So that's the summer of 2010. Now I bring us to present day. Traders, look what's happening present day. Here we are in the dollar index right now as you watch this video. Left shoulder, head, right shoulder. The market's running up now for a head test. If it fails at this head test, the likelihood is a big, big break towards the downside. Let me show you what that looks like. Remember, first you build it. Left shoulder, the head, the right shoulder. Then lots of times you get the test which fails, a test of the head. If you fail there, the big break comes. So same chart. showing you just like what happened in 2010. Left shoulder, head, right shoulder, runs up near the head test area. This is us right now as we speak, present day. If you fail near the head test area, you should drop just like you've seen the dollar index do in 2010. Now let's look forward because there's even more. Look at the 30-year T-bonds. We all know, and if not, I've already discussed with you, if dollars rally, usually T-bonds rally as well, and if dollars go down, usually T-bonds drop with them. Look at how interesting. I just showed you the dollar index had a left shoulder, head, right shoulder, which usually is a bearish formation. Well, look, it's running up to the head test area exactly like the dollar index chart. This is live, real time as we speak, just like the dollar index chart. So traders, look at it. Shoulder, head, shoulder, running up for the head test. This is right now in the dollar index. Extremely important over the next few days and weeks ahead to see what happens at this head test area. If you get through it, away you go. And of course, it's not a head and shoulders, and bonds and S&P will go opposite one another, and bonds and dollars stay bullish. So let's see what happens here. What I think will happen is this. Just like I showed you a couple of weeks ago in copper in one of my shows, copper had a head and shoulders formation, a little one, left shoulder, head, right shoulder, and look at the dump. Then what you do, it builds another left shoulder, a head, a right shoulder, has a little baby head test which fails, and a big, big breakdown ensues. This is what you should get when you have a head and shoulders formation in a market. You see how well it worked in copper? I showed you how well it worked on the dollar index in 2010. Here we are looking at the same formation present day in dollar index and bonds, just like you've seen recently here in copper. This is usually the end result of a head and shoulders. Let's look forward. Now, if the dollar index and the bonds look like they're topping out with an upright head and shoulders, which is bearish, look at what's happening with the NASDAQ. Right now you have the NASDAQ building an inverted head and shoulders, the opposite. Left shoulder, head, right shoulder. Usually this inverted look, opposite that, right? The one we're looking at now looks like this. Opposite the upright. This is the inverted head and shoulders. The NASDAQ trades opposite of the dollars and the bond market. So, if the dollar and the bond market has an upright head and shoulders right now, which is usually bearish, that means this is probably an inverted head and shoulders, which is bullish in the NASDAQ. Not only does NASDAQ have this inverted head and shoulders, look more. It's above the 200 bar moving average right now in the right shoulder, and on top of that, it looks to me like the NASDAQ has built a bull flag in the right shoulder on top of the 200 bar moving average, and that is a very, very important moving average. The entire street watches it. I know fund managers all over New York, all over Chicago, they watch the 200 bar moving average. They key on it. If we're above it, they're buyers. If we're below it, they're sellers. So if the dollar index has this upright head and shoulders, which can usually be bearish with the bonds, then this is likely an inverted head and shoulders, which is bullish with a bull flag in the right shoulder. Traders, here's what has to happen. You cannot really do anything with this advice yet until the next couple of days, and we see if we hold inside here and take off. And of course, at the same time, if the dollar index fails at its head test. This is what's most important. We want to see the dollar get up here and fail and then have its dump like it did in 2010. If that's the case, then what I just showed you in the NASDAQ will turn out to be an inverted head and shoulders. NASDAQ and the stock market will go up. Dollars and bonds will head down. That is what I am showing you with the big head and shoulders. That is what's happening when you miss or fail at the head test area. Traders, I want you to pull your own charts, do your own homework, Go look at the Head and Shoulders back in the summer of 2010 in the dollar, see what it did. Then take a look at what's happening right now in the dollar index, compare it to the bond Head and Shoulders, and then we have something to sink our teeth into. Technically, this is a formation that will almost always give you a down arrow if the head test area does fail. Traders, I really hope this helps to keep you in tune with the markets going forward. This is not information to trade exactly for tomorrow or for Sunday, Monday when you see this video. This is for you to gauge what is going to happen over the next few days and weeks ahead. Traders, make sure you do your own studies and compare them to the studies we just showed you here in the Chart Laboratory.
Making money in the markets is not an easy thing to do.
That's why I ordered this free book and demonstration disc from Metastock.
Metastock uses technical analysis, good solid information.
Not just hunches or guesses. This helps me make better trading decisions.
I find the best trades and I can decide when to buy and when to sell.
With Metastock, I trade more confidently.
And that's helped me be more successful.
Go to metastock.com/TG8 right now for Metastock's free demonstration disc and a free book on trading strategies.
Traders, welcome back. Oscar Carboni here coming at you. And hey, traders, technical analysis, how does that work? Look, use Metastock. I am telling you, it is the best program for analytics out there. You've just seen what I've shown you. All the work I've taught myself comes from this program. Very inexpensive. Go get yourself the same program so you can emulate the same exact work I'm teaching you. Now, traders, remember, these videos and these shows, these lessons, especially this one about the dollar index Head and Shoulders, this is something that we watch and hope it turns into. I never ever say what a market is going to do. A market, the market, it's always right. So I am not here to say it's definitely a Head and Shoulders, but it looks like one, and we need to be watching it, because if that is a Head and Shoulders in the dollar index and the bonds, and they do top, that means the stock market will gain a lot of legs before this year is over. So let's keep our eyes peeled on that. Now, traders, one of the things I really need to hit home with you and express so that you never forget this is that this business is extremely risky. And in my career, down on the trading floors, I have seen more of these guys get carried off the floor, so to speak, because they did something insane by trading without protective stops. I want you to always place a protective stop on any trade you are going to get into. Put the stop in before you trade. Traders, listen, I want to show you something just so that you'll remember this when you go to trade. Take a look at this quick short. I'll be right back to you. Hello, sir. May I help you?
Oh, hi. Good day, sir. My name is Mike, and we are conducting a survey on traders. The survey is about stops. Do you use stops?
Get out of here. We don't use stops in this industry.
No stops.
We don't need no stinking stops. In fact, get off my property. I don't speak to anybody who uses stops. Get out of here. Forgot to use my stops. Welcome back, traders. Hey, that is no joke. I am kidding you not. I have seen so many of these guys lose their careers on a one-day flash crash like we've seen in the past without having protective stops. So don't end up sitting in the desert with your hands behind your back. Make sure you place your stops and place them first. Traders, these shows I've been doing for you week after week, night after night on YouTube, week after week here in Vegas, these shows are to teach you these fantastic techniques that work on analysis, they work on charts, and those charts are the roadmap to where future pricing is going. If you've been watching these last few shows, you will see that almost all the techniques I've put before you have actually come about on the charts and worked out the way they were supposed to. Now, we all know that technical analysis will never work 100% of the times, which is why we place our stops, which is why it's so important for you to place yours. We place ours. We never trade without them. I know I'm spending some time on this, but I hate seeing traders get destroyed by not having stops in. So keep that little short in mind. All right, so going forward for the next few days, if that dollar index tops, it's going to get exciting here for the stock market. But the other side of the equation is this, traders. Let's say the dollar index does not top out here and the bonds do not top out here. Well, then the end result of this year will be much lower than we are today. So this is an important video. Those were very important structures or formations on the charts for you to pay attention to. And again, it's not for running out and trading on Monday after you watch this video Saturday. And it's not for running out and trading on Thursday if you watch this video Wednesday night. It is for you to pay attention to for the next couple of days and weeks moving forward, because I assure you this, if the dollar tops out here, the stock market will explode. That is what usually happens. And traders, there's a lot of traders out there that are talking about, Oscar, don't you see that this looks just like it did in 2008 into 2009? And then there's a lot of crazy stuff on the internet that compares the chart today of the Dow to the chart in 1929 and 1932. Traders, listen. Big difference. First of all, the crash of 29 was the crash of 29. This is 2011. Let's leave that one alone. The crash of 2008 into 2009, we had crude at $145 a barrel. We had the derivatives markets in the United States melting down. We had real estate in the United States crumbling. And we had banks and car companies begging the government for money as they were becoming insolvent. That was 2008, 2009. This is 2011 going into 2012. Situation is different. The stock market has been coming off of its crash for the last 2 years and should continue in that direction. We do not have crude at $145 a barrel. We do not have banks insolvent or going insolvent in the United States. And we do not have a crashing real estate the way it was crashing then. We are in much better shape than we were back in 2008-09. So I don't want you to worry, and I don't want you to read this craziness off the internet. If in fact we are going to drop, the beauty of what I teach you is this. You will see the formation build, a bear flag, an inverted head and shoulders, or an upright head and shoulders, a swing day will show up. Something will show up on the charts that will give us the high sign that we are going to have another crash. But that is not what we're seeing. If it happens, we're day traders. When it wants to go down, we sell. When it wants to go up, we buy. The beauty of what we do is that we trade each day and we use the techniques that I show you to gauge market movement. But at the end of every day, we get out of the market and we are flat in cash. What does that do for us traders? Another thing I'd like to discuss with you. It's a clinical disease, if you will. The clinical term is called confirmation bias, and this is what it means. If you, let's say, go home short the market, and then you do your analysis at night because you've been short from Wednesday and it's Wednesday night and you're still short. When you put that chart up, I don't care if it's the most bullish formation on the planet, your mind's eye is going to see the chart as bearish, confirming the bias that you already have in your position. Now, not everybody falls into that trap, but we are human, and 99% of us are going to look at a position, especially if it's against us, and we're going to look at our charts in favor of the position and not what the chart is actually showing us. That is called confirmation bias. That is why I tell all of my Omniacs, you get out of your trades at the end of every day, so when you do your analysis at night, it is pure and unjaded and there is no confirmation bias. I assure you that if you are a trader who does trade, day trade, and when I say day trade, I don't mean in, out, in, out, in, out like those crazy scalpers. I mean, you get into the market after doing sound analysis on your meta stock, you found a great place to buy with a stop, You wait for the market to hit your buy level. The stop's already in. When it rallies up enough points, you get out. You're done trading for the day. That's the type of traders that we are at the Omni Trading Academy. That's what I mean when I refer to day trading. Not scalping. Scalping, I think, is for losing traders. You cannot outsmart the market 20 times a day and expect to do that every day during the week and win. But you can gauge the market via the charts, using technical analysis, knowing this: fundamentals always come out in the charts first. If you see a formation on the chart, if it looks bullish, it's because bullish news will be coming out. The chart will show you that first. Traders, charts are merely a visual look at fundamental information and traders' reaction to such. The chart has everything in it, and we are here to teach you how to read those charts properly. So use the techniques I've taught you. Look for that head and shoulders in the dollar index. Look for it in the bonds. Take a look at it back in 2010, the dollar index, what it did then, and compare to where we are today. And I think that that is the formation that's going to take us forward. Remember, stops are always in, right? In case that dollar takes off in the bond and stock market, the bonds go up and the dollar goes up and the stocks go down. Have your stops in, right? Your stop gets hit, you jump out of the trade, you live to trade another day. So, the formations that we teach you are absolutely professional. They work really, really well. You must use those formations and create a trading plan every day and stick to your plan. If you'd like to learn how to create a trading plan and learn these formations better, simply come on down to livewithoscar.com. Jump into my free trading rooms where I am leading those rooms at the helm at all times, typing in the rooms on camera and microphone when I can be, and I am here to help teach all of you traders how to use the techniques I show you and how to get through these rough and tumble markets. The last thing I'm going to tell you, as I tell you at the end of every video, is to always, always keep your emotions out of trading. One of the best things you can do to help yourselves with keeping your emotions at bay when you're in a trade is to say this to yourselves over and over again, traders, and I mean it. It's my mantra, and I want you to say it too, and you know what that is. Stops are in. Emotions are out. Yeah. Thank you for tuning in once again. I hope these videos help. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.